the floor is yours, and yeah, you have about 15 minutes.
Okay, thank you very much. Can you see my screen?
Yes, perfect.
Okay, great. So thank you very much for the opportunity to present financial shocks, uncertainty shocks, and monetary policy trade-off, my job market paper. So there is a general consensus in the literature that financial shocks and uncertainty shocks are two major sources of business cycle fluctuations. For example, Stock and Watson in 2012, they showed that the financial crisis was triggered by a confounded mix between higher uncertainty and financial disruptions. And also Caldara, co-authors in 2016, they together explained that financial shocks and uncertainty shocks explain together roughly 60% of output fluctuations over business cycle frequencies. However, although there is this consensus of the importance of the two shocks, it is still unclear how to distinguish between them and if it is important at all to disentangle the two shocks on aggregate data. And the reason why it is so challenging to distinguish between the two is because from an empirical point of view, we can only observe endogenous proxies for financial conditions, such as the credit spread, and for uncertainty. And this implies that when the econometrician observes, for example, a jump in credit spread measured uncertainty, she cannot tell whether this has been triggered by an uncertainty shock or a financial shock. And instead, from a theoretical point of view, workhorse macro models seems to suggest that the two shocks trigger the same qualitative effect on key macroeconomic variables, implicitly suggesting that the two shocks have the same policy implications. So today, in this presentation and in this project, I will try to provide you a strategy to separately identify the two shocks, and I will try to convince you that from a monetary policy point of view, it does matter to distinguish between the two. So what I'm doing in this paper, so in the first part of the paper, I argue that corporate cash can be useful to disentangle the two shocks in aggregate data because it has a qualitative different response to financial shocks and uncertainty shocks. And this argument is supported by a partial equilibrium model and by some firm level suggestive evidence. Then in the second step, I use basically the different response on corporate cash to propose a new econometric procedure that is in the spirit of sign restriction that is able to uniquely identify the two shocks. And since I have a unique solution, this is an improvement over sign restrictions without relying on any ordering assumption. So this one is going to be an improvement, for example, for Cholesky identification. So in the third part, with an identifying assumption of the response of corporate cash, an econometric strategy, I provide an empirical application on aggregate US data. And I find that financial shocks explain roughly 40% of output fluctuations over a business cycle frequency, while uncertainty explains roughly 15%. And the second important result is that financial shocks seems to be associated with inflationary forces, while uncertainty shocks are related to deflationary patterns. So in order to rationalize this important result of the response of inflation, I integrate the partial equilibrium model presented at the very beginning in a new Keynesian framework in order to rationalize the different response of inflation and to formally derive monetary policy implications. Okay, so let me move. For the sake of time, I will have to provide intuition more than mathematical details, but I want to provide an intuition why corporate cash should respond in two different directions after a financial shock or an uncertainty shock. So keep in mind that corporate cash, from the point of view of a firm, is an extremely liquid but low return investment. So I would like you to think about corporate cash as an insurance that firms hold as a protection against cash flow risk, but they need to hold at the implicit cost of distributing less dividends, investing less in physical capital, or issuing more costly debt. So after a financial shock, the cost of debt increases. So it means that the implicit cost of holding this insurance is now larger. So not surprisingly, the firms are going to hold less of this insurance in equilibrium. And in other words, it means that firms draw down their cash reserves as a substitute for the costly external finance. Instead, after an uncertainty shock, the overall risk increases, so firms appreciate more the value of this insurance, and so not surprisingly, firms hold more of this insurance in equilibrium. That it means that firms invest more in corporate cash for precautionary reasons. And keep in mind that this simple intuition seems to be robust to general equilibrium effects and is supported also by firm level equity. Okay, with this different sign restriction in mind, let me move now to the econometric strategy. This is just to highlight the challenges and the solution for this empirical problem. So, first of all, keep in mind that the econometrician cannot observe the exogenous processes for financial condition and uncertainty shock. So the solution, this has been provided by the literature, is to use endogenous processes. For example, for financial condition FT, you can use credit spreads, for example, or for measured uncertainty UT, you can use the expected forecast error variance of macro variables, but also other variables that you have in mind. In the second step, as I told you, the problem is that the econometrician, those variables are endogenous, so they simultaneously react to the two shocks. So the solution that I provide in this project is to use corporate cash as an internal instrument. That it means that you want to identify a financial shock as the one that increased credit spread, measured uncertainty, but decreased corporate cash. And instead, you want to identify an uncertainty shock as the one that increased credit spread and measured uncertainty, but at the same time also increased corporate cash. However, the last challenge is that the different sign of corporate cash is only a qualitative assumption. So if you use sign restriction, you only have a set of available solutions. So in this project, I provide a novel econometric strategy to uniquely identify the two shocks. And the intuition, this is just an intuition, but if you are curious, we can chat later on more on the details of my econometric strategy, is to provide enough relevance to the response of corporate cash to obtain orthogonal shocks. Okay, so said that, let me move to the empirical results. So we have the identifying assumption on corporate cash, we have an econometric strategy, let's go to a structural VIII. So I'm providing as a baseline, but results are pretty robust, a 10-dimension VIII where I have measured uncertainty, credit spread as the excess bond premium, corporate cash from the flow funds, output, consumption, investment, hours, inflation, the real stock of money, and the federal funds rate. So data range from 1982 to 2016, but keep in mind that results are robust, and for this baseline, I use only one leg, following the Bayesian information criteria. So these are the response to the impulse response into a 1% financial shock. So as you can see, credit spread and measured uncertainty, they both jump on impact. Corporate cash falls for following the identifying assumption, and a financial shock has a contractional effect on output, consumption, investment, and hours. But importantly, notice that the GDP deflator display a positive and significant response to financial shocks, suggesting that financial shocks are associated with inflationary forces. These ones instead are the responses to a 1% uncertainty shock. As you can see, credit spread and measured uncertainty are both jumping on impact as well, confirming the problem of endogeneity that I was telling you before. Corporate cash is rising with a lag, also in this case following the identifying assumption. Also, analogously to a financial shock, also uncertainty shock has a contractional effect on key macroeconomic variables, output, consumption, investment, and hours. But importantly and differently from a financial shock, uncertainty shock seems to be associated with deflationary forces because the GDP deflator display a negative and significant response to an uncertainty shock. Okay, so said that, let me jump to the model. Remember, this model has the goal to rationalize the response of inflation and to derive monetary policy implications. So the model is a standard free equation UK and Asia model. I'm going to have goods, the only novel ingredients are good specific habit. That means that each firm now has a customer base. Keep in mind, because this assumption is important. I have, for financial shocks, I have costly external finance. That means that when firms use external resources, they incur in additional costs. And then I have a market for cash and liquid assets to rationalize the response of cash. And in the end, my model resembles the one of Gilchrist and co-authors, plus a market for cash and liquid assets. Okay, so said that, let me focus on the response of inflation in particular. So this is the only equation I have for you in this presentation. This is the first order condition for prices as a first order approximation. So think about this equation as the Phillips curve. Okay, so if you are familiar with the Phillips curve, this is simply the Phillips curve, where pi t is final good price inflation, eta hat is a positive function of the parameter, and ct represents the value of an additional unit of internal funds. So ct basically is the multiplier associated with the flow funds constraint, and if the firms need more internal sources of finance, if the firms want more internal resources, then C is going to increase, okay? And the reason why C enter positively with inflation is because given the existence of the customer base, firms have the incentive to raise prices when they want to generate internal sources of finance. So again, since you have a customer base, you want more liquidity, you want more cash flow, you want to generate more cash flow, then you increase prices because the customer base has a low elasticity of demand. Nu T instead is the multiplier associated with the final good demand. So, and Nu T basically is the value that you find in a textbook New Keynesian model, and simply says that when there is a falling demand, this is associated with deflationary pattern, no more than that. So the reason why Nu T enters negatively follow the same intuition of New Keynesian model, standard New Keynesian models. Okay, said that, why financial shocks and uncertainty shock move inflation in two different directions. So after a financial shock, firms want to generate more internal resources because there is costly external finance. So the ratio between CT and NUT increases, and so inflation increases as well. Instead, after an uncertainty shock, for a precautionary reason, households want to consume less and save more. So since they want to consume less, there is a fall in demand. So the multiplier associated with the demand increases. The ratio between CT and NUT falls, which implies that inflation is decreasing at this point. Okay? So said that, which are the monetary policy implications? So financial shocks move inflation and output in two different directions. So this creates a trade-off that the central bank is facing between output and inflation. And in particular, during a financial crisis, the monetary authority can close the output gap only at the cost of higher inflation. So this is the trade-off that the central bank is facing after a financial shock. Instead, after an uncertainty shock that moves these two variables in the same direction, the so-called divine coincidence is still in place. What is the divine coincidence? Is simply saying that conditional on uncertainty shocks or during an uncertainty-driven crisis, the monetary authority can simultaneously, this is very important, close the output gap and the inflation gap. So two very different policy implications. So I think I am almost out of time, so let me conclude at this point. So I hope that in this project I convince you that there exist two different sources of business cycle fluctuations, financial shocks and uncertainty shocks, that are both associated with more uncertainty and higher credit spread. And besides the labeling of financial shocks or uncertainty shock, what I try to convince you is that corporate cash provides useful information to quantify how much economic fluctuation are inherent to the real sector or to the financial sector. And the third point is that central bank deals with very different challenges in face of the two shocks, making the case undoubtedly important for policy implication. So this is all I have for you today, and thank you very much for the kind attention.
Thank you very much, Marco. So according to program, I suggest now to listen to next presentation, and then we will try to provide you with some comments and suggestions. So the next presentation, the next presenter is Jing, Lian, Suah. I'm again sorry if I'm pronouncing in the wrong way. And the floor is yours.
Everyone can hear me, right?
Yeah, great.
Yep. So this is this paper is a mixture of this paper has two parts. So it's a mixture of a bit of macro theory, and then also the second part will cover a bit of empirics as well. The conceptual part really is to build intuition for the results later on. But I'll go through the motivation first. So very recently, I think since 2018, 2019 onwards, the degree of policy uncertainty has just increased quite substantially, and much of this really brings into question, it's the kind of economic growth that we saw in the 2000s and in the immediate aftermath of GFC, really sustainable. And if we look at the long time series of GDP growth across advanced and emerging economies, excluding China, and then overlay it against the policy uncertainty index by Bloom, Baker, and Davis, what we see is that there's this coincidence between a long downward trend between growth and then the long uptrend in uncertainty as well. So then the implication for policy is then, okay, as we confront a new reality of really high uncertainty and new risk outlook, then post-COVID as well, what this means for monetary policy and fiscal policy, etc., in supporting growth, supporting economic growth. So that's really mainly the policy motivation of this study. And in the literature, the literature covers pretty much quite well, the impact of the real effects of uncertainty shocks. No matter how you measure, there are many ways to measure it. Most common one, the policy uncertainty index by Bloom, Baker, and Davis, and more famously as well, macro uncertainty shocks estimated with a stochastic volatility model by Gerardo Ludvigsen and Ng. The documentation, the literature points us to really three things. Number one, there's this persistent slowdown in output, and it really depends on how you measure uncertainty. Sometimes there's a correction in some countries. In some studies, there doesn't seem to be a correction, some post-shock correction in output growth. There's some signs of non-linearities as well. So Alessandri and Muntas documents that there's this non-linear effect during periods of financial stress or financial crisis. Jackson, Clayson, Ouyang documents that there could be a jump when uncertainty increases. There could be additional jump effect when uncertainty rises by a very large amount. And much of this is underpinned by really three strands of theoretical understanding. First, precautionary savings. I think this is pretty much what Brianti earlier talked about as well. Corporates and households just hoard cash when there's uncertainty. When uncertainty rises, because there's come to this decision paralysis. Likewise, real options effects. Labor, employment, and investment decisions are just very expensive, costly and irreversible. So there is decision paralysis as well. Or could be seen as just simply an aggregate demand shock, a slowdown in information flow. But the financial responses are a lot more ambiguous. And what Campbell et al. Finds is that, okay, it really depends whether it's an emerging or advanced economy, and even then matters which currency you're benchmarking against. And the impact, the real effects of exchange rate, and in contrast, the real effects of exchange rate and capital flows are a lot better documented. Much of this points towards that there's a distributional dimension, both on an inflation end and also a growth point of view. And also at a firm level, perhaps there are sectoral compositional effects or some sort of Penn-Balassa-Samuelson effect that services sector benefits from currency appreciation differently, and the net compared to the manufacturing sector, and the net effect on productivity and output really just differs quite substantially. So, building from all of this, this experience, these questions that come up from macro surveillance and macro policy making. There are really two questions. What's the dynamics between uncertainty, exchange rate, and aggregate output? And the exchange rate component is important for a lot of small open economies that have open capital accounts, and especially for EMEs that currency movements affect financial conditions and domestic demand quite substantially. So there's this policy motivation, and then we really need to understand why are these real effects emerging in the first place. So the conceptual model will address the second part, and then the empirical findings vars and employ a couple more panel data approach as well. We'll address the first question. So the conceptual, I'll just briefly go through the conceptual model because of time, but there are 5 main components here in the conceptual in this conceptual model that we have. The households have time varying risk preferences. So during periods in which uncertainty is high, they become more conservative. Discounting factor, if you put it, tends to become higher, tend to save more, and this really affects how they allocate savings as well. So it affects two things: the quantum and also allocation of savings. Second component is that the households and firms are also rationally inattentive. So they place a lot more weight on the immediate past. So this really reflects that people are forgetful, and it's costly for companies as well to dig up old information and try and remember, the long run of economic trends, and decisions are often made on a momentum basis. So this really reflects that reality in household and firm behavior. And last one, bounded expectations. In a way that expectations, households and firms cannot form accurate expectations of inflation and growth and economic growth, which would inevitably depend on affect how much they save and which assets they save in. So in a model, what I did was what I illustrate is to borrow from existing literature from especially notably Jing 2018, where the household places particular weight on between the central bank's forecast and somewhat the best guess of the economy's state of inflation and growth versus their own forecast, their own estimate, which is documented also across the literature that there is an upward bias in household expectations. For businesses, perhaps that's not so much the case. So that's really the 3 components for households and firms. For policymakers, there are 2 components here: cognitively limited, in the sense that they just to reflect the fact that policymakers do not have, central banks included, do not have complete and full information of the economy, and oftentimes even contemporary data is released with a substantial lag. For example, GDP releases, inflation data releases often come out a quarter late. Advanced economies have it better, but even then there's still a substantial lag. It's really to characterize the fact that at the aggregate level and also at the more micro level, policymakers do not have that information, and there are lots of us. So it's really just a standard way of characterizing how policymakers assess the economy and then respond with interest rate changes. So the traditional explanations, as pointed out earlier across the literature, really points to precautionary savings, real options, and uncertainty traps. And what I offer here, the conceptual model offer here, is that perhaps there is possibility to look at the real effects of uncertainty from a macro behavioral point of view. I do not bring this to a new to a quantitative application, but certainly that is possible, though out of the scope of this paper, I believe. So what this means is that really uncertainty, because of your rational inattention and cognitive limitation experienced by households, firms, and policymakers, uncertainty shocks amplify the expected loss and also gets firms and households to behave excessively conservative because they're more informed by the very immediate past. If there's a shock happens, it tends to be more self-fulfilling as well. And much of this really prompts policymakers to respond a lot more aggressively, which is basically what we have seen at least in the first half of the year. When there's high uncertainty, very little clarity, the policy response really is to take the extreme end and go for extreme end and respond very quickly. So all of this really is to characterize, based on some most stylized facts of the economy. I'll upload the slides later as well, so if anyone wants to go through in detail. So the household really follows the standard utility maximization, etc. and so forth. The bottom end here really shows that characterize the time varying risk preference here, and how households invest across assets that are considered hedge assets and also risk assets. So you can think of risk assets as investment in a real project or in a business project, or equities, and a hedge asset could be a bond or something. They have different implication on economic on output and also wider productivity of the economy. Saving behavior is really dependent on this parameter here. And again,
Jim, I'm sorry to interrupt. You have about 4 or 5 minutes.
Yep, I'm aware of that. No worries. The household, so and this is an extension of it. Expectations are bounded and split between the central bank's forecast and their own. When uncertainty is high, gravitates towards their own, unfortunately, their own bias forecast, their own estimates of expectations, which may be biased in some ways. I'll skip the rest because it's not too important actually. The intuition is in the front. So the empirical section employs two data sets. The first data set is a panel data that covers a wide variety of 16 advanced and emerging economies. It's available on a monthly basis. It covers about 70% of the world. The choices of variables are really taken from standard empirical macro literature. And the second part, the other data set focuses mostly on Malaysia. There's a global block summarized with global output, global GDP growth variable, and then the economic policy uncertainty index. The world GDP component here covers a wider range, covers more of the global economy. It's because of data availability at a quarterly figure, the quarterly frequency compared to the panel data, which is done on a monthly basis, and some of the variables are just unavailable. The empirical approach uses a series of VARs, and then later on I try and use the data to try and tease out whether the data covers some form of non-linearity or otherwise. So the main focus really is the max uncertainty VAR, which was used by Jackson, Clayson, and Ouyang. The additional variable is what's different between a normal VAR and the max uncertainty VAR is this variable here, which switches on when uncertainty jumps at the level higher than the immediate past immediate past year. Yeah, these are the responses to the global EPU shock. Also, there are restrictions on the coefficients such that Malaysian shocks from Malaysia do not feed back to the global block because a small open economy. The responses are really not too different from standard literature. That employment tends to be persistently moderating compared to GDP growth. Generally, during recessions or downturns, labor markets recover slower. That's really an empirical fact. What's interesting here is the divergence between GDP growth and employment, and I really attribute this to the compositional effects are shown earlier in the exchange rate and capital flows literature, that an appreciation shock benefits the less productive, more labor-intensive services sector, but the quality of output in those sectors are just a lot less than the manufacturing sector. That's why you see this divergence here. But for policymakers, what matters really is still GDP growth. And I acknowledge that these findings here may differ for various other countries. And really, when we move on to the panel for our findings, the uncertainty shocks responses are pretty much standard. CPI inflation is rather inflationary. The response is quite inflationary, actually. And this is really what the macro behavioral part of the story comes in. The innate biases kick in for the households. Yeah, so when you move on to the country-specific estimates, the magnitude for responses, upper responses are quite different. And for exchange rate, the response to output exchange rate shocks is also very heterogeneous. So this could really be capturing, compositional effects, how the dominance of services versus manufacturing sectors and also trade intensity are very different across different countries. I'll skip the last part, actually. So in essence, two things. The one, it may be possible that we can bring this to a quantitative setting, try and characterize how macro behavioral frictions interact with uncertainty and exchange rate shocks, and what this means for policy. We can't do policy inference here in a VAR setting, panel VAR setting. Estimates could be noisy and mostly rather noisy as well. So yeah, I think that's about it. If there are questions, do consider shooting me an email or anything. Yeah, thank you. Looking forward to the discussion or questions.
Thank you very much. As we now we have two options. If the fourth presenter, and according to program, it is Neeti, Mathur, and Himanshu. Mathur, I'm sorry once again for the pronunciation. If they are ready, we can listen to them. And if not, we can discuss the first two presentations. I see that Neeti is here. So if
yeah, I'm here. So
yeah,
I'm ready to present also.
Great. So I suggest you present, and then we will discuss all the papers. Yeah. Yeah.
May I share to the presentation?
So try to share the screen now, please.
May I or?
Yeah, you can.
Yeah, so please make me host so that I can share. Make me co-host.
I think now you can share. At least my Zoom is telling me that you have this this right.
Fine.
Mm-hmm. Yeah, great.
My presentation is visible to all present over here. There.
Yes, perfect.
Yeah. So the topic of my presentation is analysis the impact of COVID-19 on pharma stocks listed on NSE India. And this is authored by me and Himanshu. So I'm starting it. So what the content I'm following is introduction, research objectives, formulation and data description, research methodology, data analysis, findings, and further conclusions. So why the reason of choosing pharma sector for the analysis? The reason being is that due to the COVID-19, the pharma sector was like the medicines, and this sector is really in demand due to the demand of extensive supply of medicines, medical equipments, and all. And also, Indian pharma sector is very prominent even in the world. So it's having the third position in the world in the production and 13th position in the world in the volume of the produce. For this analysis, there are 13 companies of NSE Pharma Index. From those 13 companies, we have chosen 12 on the basis of availability of the data. And the paper is actually divided, this paper actually analyzed the performances of the pharma industry post-COVID and during the COVID and during the whole duration. So this is the Nifty Pharma indices. I have just take one picture of it to show you. It is visible that during the month of April and during the month of January till April, it was actually facing the decline, and then it is moving towards the upward direction. And if we see, it is moving towards the upward direction. So this is the Nifty Pharma indices. The research motives, or we can say the research objectives for this research are, just 1 minute. To calculate the average return, risk, correlation, variances, and beta of the constituent stocks of Indian pharmaceutical firms during May 2019 to April 2020, to compare the performances of the Indian pharmaceutical firms for the above-mentioned time horizon with Nifty Pharma indices, and to find the impact of COVID-19 on the performances of the Indian pharmaceutical firms. So for that purpose, there are several there are the approaches which we have used for analysis of risk, return, beta, and covariances and variances. The total risk is measured by the mean variances approach, and the formula which is exhibited here is used for the purpose. And here x1 is possible return, x bar is the average of the possible returns, and p is the probability of the returns and number of the possible returns. So by this formula, we have calculated the mean variances. There are some other formulas which are used for the correlation, calculation of the beta, and also for the calculation of the systematic risk for the regression model. So correlation is calculated by the exhibited formula, right? And then beta is calculated so by the regression methods to measure the systematic risk. I'm not explaining the whole formula. And standard deviation, we have used the standard deviation also because this is one of the measure of the risk. And correlation coefficient, so this is also to find out the relationship between the two random variables. One is the indices and one is the individual company's stock. The calculation of the return is done on the basis of the weekly closing prices of the discussed time period, and in this, the price that is the Friday closing price of the stock in the I plus 1 week, and PI is the price of the stock of the ith week, and the formula it is mentioned as y is equals to Pn plus I minus IP and 100 upon Pn. So this is used to find out that how much change in returns is visible. Then mean variances approach is used, and yeah, so it is mentioned here. So this is also I have discussed. Then risk is measured. So this is the way standard deviation calculation, but the risk is measured. Now I'm coming to the results, and here the result is divided into basically two parts from February 2020 to April 2020, because the study was conducted till April 2020. So the COVID outbreak starts in India from February 2020, and the calculation is done till April 2020. So sorry, just 1 minute. Yeah, actually there's power cut here. So, so here the return risk and beta factor and correlation variances are calculated, and for that the February 2020 to April 2020 data is used. So the company names are mentioned here, and the risk is calculated, return is calculated, beta and correlation is calculated and also variance is calculated for the time period. It was found that during this period, the Aurobindo Pharma is actually is the highest at the highest risk, and returns also this Piramal Industries is giving the highest returns. And when the beta is calculated, it was found that Piramal Enterprises is of having the highest beta. So highest beta, it means that highest risk is associated with this. And as far as correlation is concerned, the highest correlation is exhibited by Lupin Limited and Cifla Limited. That is the lowest one. And for this variances, the Aurobindo Pharma Limited is showing the highest variances with the indices. Now, the return which is calculated for which is calculated for the pre-COVID period. So the pre-COVID period is May 2019 to January 2020, and the results are exhibited in the table. And as per the results, the return is highest of the Piramal Enterprises. Sorry, risk is highest of the Piramal Enterprises, and Aurobindo Pharma is exhibiting the lowest returns, and highest of Glenmark Pharmaceutical Limited. Beta is actually the Piramal Enterprises is showing the positive beta, that is 0.118, and Dr. Reddy Laboratories is showing negative beta minus 0.152, and correlation is exhibited negative, the highest negative by the Cifla Limited, and positive highest by the Dr. Reddy Laboratories, and variances are exhibited highest by Dr. Reddy Laboratories. Then I have just collected the data and find out what is the overall performances of the companies during the whole time period, May 2019 to April 2020. So that is the span of the 1 year. And it was found that the Aurobindo Pharma Limited is at the highest risk, and Dr. Reddy Laboratories at the lowest one. And Davis Laboratories is exhibiting the returns, which is negative one, and Piramal Enterprises the positive returns. Beta is highest of the Piramal Enterprises, and correlation is highest of the Piramal Enterprises. Aurobindo Pharma is showing the highest variances. So this is the descriptive statistics of all the variables, and this descriptive statistics is showing that the minimum risk is 4.644 and maximum is 51.430, and the returns are 15.29 and the maximum values are 43.267, and correlation is 0.42 and 13.863. So this is for the next period, and it is visible that the risk is like the risk span is very low. It's 4.196 to 9.365, and it is from the May 2019 to January 2020. So less risky period. So this period is less risky for the companies as compared to the COVID period. And the returns are also varying from minus 46 to 83.475. So, and correlation is 0.006. So this was the correlation. Then, yeah. So then from May to April 2020, May 2019 to April 2020. So the picture shows that the risk is actually ranging from 4 to 16, 4.0092 to 16.722. And the minimum value of the return is minus 30 and maximum is 102.085. So this was actually studied, and finally the conclusion is drawn that during the COVID period, Aurobindo Pharma has the highest risk, and Piramal Enterprises has the highest returns, and correlation is highest of the Lupin Pharma. So these are actually the pharmaceutical companies which are indexed in a Nifty Pharma Index. Then before the COVID-19 pandemic period, May 2019 to January 2020 shows that the Aurobindo Pharma Limited has highest risk and the lowest return. And while Dr. Reddy Laboratories has the lowest risk, and Alchem Laboratories shows the highest return. So this was exhibited in the whole discussion, and Cifla Limited shows the highest negative correlation, while Dr. Reddy Laboratories shows the highest positive correlation with the pharma indices. And during the entire period of May 2019 to April 2020, the highest risk and return are shown, and the variances and beta factors are also these. Just 1 minute. Yeah. So Piramal Enterprises has shown the highest risk and the return, and the variances and beta factor are also highest for the companies. And during the COVID-19 pandemic period, February 2020 to April 2020, risk is highest, while the whole duration period from May 2019 to April 2020. So return was highest during that period. So the COVID-19 impact, the risk and return of all the firms, risk and beta factor is highest during the pandemic period in comparison with the pre-COVID-19 and entire period of the study. The standard deviation is also high, and the minimum variances is very low, and maximum variances are significantly high, which shows that the volatility is high in during this period as compared to the entire period from May 2019 to April 2020. So this study has conducted on the pharma firms, and these are the conclusions and findings. So thank you.
Thank you very much. So we have a lot of time for the discussion, and so I was keeping notes, and I will try to start the discussion to facilitate it. I don't know much about macro, so perhaps my comments might be silly. I hope not. Marco, can you show please slide 3?
Absolutely.
I don't remember exactly. So that was the slide with your motivation that about the difference in shocks, if I'm correct.
Okay. This one?
Yeah, exactly. I was wondering, so I like very much this your discussion about different outcome in terms of corporate cash for financial and uncertainty shocks. But I was wondering if if cost of debts, if cost of debt increase, so that would decrease insurance. However, if risk increase, that would increase insurance. But is it possible that increase of risk would also increase cost of debt?
Yes, that's a good point. So this is no. This is a very good intuition. This is called this is the so-called financial uncertainty multiplier, that basically says that if there is more risk, a bank may charge you higher interest rates because there is more risk, and so an uncertainty shock may appear much closer to a financial shock rather than uncertainty shock. And and your intuition is completely correct. And at this point, it becomes a quantitative matter. So how much the channel that you highlight is strong, and is strong enough to such that corporate cash is moving in the opposite direction. And so what basically I've done is analyzing the general equilibrium model for different calibration, and show that although this channel is in place, so the financial uncertainty multiplier is there, is not large enough, is not strong enough to change the response of corporate cash. So this is everything I can do to try to defend my identifying assumption. But your intuition is correct. So.
Yeah, thank you. And also, can you show slide 6? I think it was 6 with the impulse response function, if I'm correct. Yeah. So am I correct that the result for GDP deflator is not statistically significant? I mean that the confidence intervals there too.
No, on impact is significant at 95% on impact.
Ah, yeah.
You cannot see very well, but wait.
Okay.
It's not huge. So even if you look at the forecast error variance, so financial shocks do not explain too much of prices. So the effect is not huge. I'm not trying to to claim that the effect is large, but the effect is qualitative going in the opposite direction, making all the implication that then explain later on.
Mm-hmm.
But
Thank
if
you.
you have small response, it's because the response is small.
Mm-hmm. And my last comment, it is not related to a particular slide. I was just thinking that, for example, in case of Russia, 60 years ago, our central bank completely changed its target politic. So previously, the idea was that we are trying to target to keep the exchange rate more or less stable. I mean, ruble to dollar. And after that, the target was and now is inflation. So to have inflation, then that I don't remember the number, but that I mean I don't know have a clear intuition how it might affect, but maybe the effect, maybe if you estimate your vector after regression on some subsamples by type of, I don't know, central bank politics or something like that, maybe you have some interesting result, because the type of variation, the type of I don't know, the source of uncertainty might be different. At least in Russia, that was very dramatic change, and in terms of macroeconomic. So, for example, after that, we know that the inflation would be, the government would be try to target the inflation and before and not the exchange rate. So maybe
I see. No, but it's very clear your point. So there are two exercises that I can do. The first one is try to do a empirical counterfactual, try looking to different monetary policy regimes and see how an uncertainty or a financial shock affect the economy, given the two periods. Or another exercise that can be done is using the model to do counterfactual exercise. For example, now that I have the model, I can look to a world where the central bank cares more about inflation or cares more about output.
Mm-hmm.
And with this kind of exercise, I can tell which kind of recession you obtain with different monetary policy regimes. And this is actually the exercise that I do in the model to say that with a financial shock, the central bank can close the output gap, that it means can shrink the contraction only at the cost of higher inflation. So in case of Russia, if they decide to give more weight to inflation, then it means that through the lens of my model, after a financial shock, inflation is going to be more stable, but at the cost of a larger contraction.
Mm-hmm.
Does it make sense?
Yeah, thank you. And I just noticed that our last presenter have just 5 minutes, so let's perhaps let's discuss her paper. I mean, I had just 2 comments. I don't know if they are helpful or not. I suggest you to put in one table the risk measures which you have calculated before and after COVID, and to test if the difference is statistically significant. I mean, whether the correlation, beta and other risk measures, if the difference pre and post-COVID was statistically significant. Yeah, perhaps if anybody have some suggestions to Neeti, please share them now as she had to go.
Yeah, I'm sharing my PPT.
Sorry, what?
Yeah, please.
Yeah, my suggestion was just to test if the difference in risk measures before COVID and after COVID was statistically significant. Yeah. And
So sorry.
Marco, what?
Sorry, could you please repeat once again?
Yeah, sure. I mean, you, as I understood, you were analyzing the evolution of some risk and return indicators before and after the pandemic, right?
Yeah.
And my suggestion was to test if the difference, for example, between pre-COVID beta and COVID beta, if the difference is statistically significant or not.
Yeah. Yeah. So definitely I have incorporated. And yeah, so I have just incorporated the risk and the other parameters like covariance, like variances, standard deviations, and also the return beta. So which I have calculated for the risk period and also for the period that is prior to the COVID-19. And then it was found that there is a deviation, and there is a lot of deviation in the returns. So returns are low in the COVID period and risk is high in the COVID period. Beta, that is also one of the measure of the risk, market risk. So this is also high during this COVID period, and this was found. And variances are also high during the COVID period. So it was found. And overall, if we see for the longer time duration, so maybe the picture will be different. But as the study has conducted for the 1 year, so it has been visible that the COVID period is actually impacting the industry a lot during the span of this study span of February, March, and April, 3 months. So as it is further studied, even till the COVID period ends. So definitely it will give us a different picture and different picture of the impact of the COVID on the pharma sector. And also the same study can be conducted on across different sectors and across the indices. So we can take the Nifty 500 or maybe different indices over the world can be this study can be conducted, and we can find out what is the changes in the risk and return beta during this COVID-19 period. Thank you.
Yeah. Jing, Marco, do you have comments for Neeti? So
no, I think I'm good. No further comments actually.
Yeah, and I have a comment for you. The first is not comment but question, and it is silly. What is EPU index? I don't know it.
Oh, right. So the EPU index is the economic policy uncertainty index. It's first introduced by Baker, Bloom, and Davis. I think in 2016. I'll send a link where I got the data set from. It's also available on the internet actually. So what they did was to scan through historical news outlets, I think, and to try and gather, how many times words associated with uncertainty, economic policy uncertainty, shows up in the news, in mainstream news, and then they try and aggregate it into an index. They run back audit checks as well, using with human eyes. So there are back checks as well, and they do this initially for the US, but there are multiple spin-offs from other papers as well, and they're available for multiple countries across advanced and emerging economies like Singapore, Korea, I believe Brazil, Russia as well.
Mm.
Yeah,
great, good to know, because it is really not a comment or suggestion, just thank you for referencing the paper. I think it was slide 16 on paper about lasso, which use lasso for this.
Which one?
16. Slide 16.
Yeah.
Yeah.
That's the methodology paper slide,
right? Yeah. Just interesting. I mean, no comment. I was just, I'm wondering. I want to read it because I've never seen such application.
Which one are you referring to?
Lasso.
Lasso.
Yeah. Lasso. Yeah.
So Lasso was first introduced in, I think, 1996 as a way to.
I mean, since I have some background in data analysis, I have seen quite a lot of applications.
To see it used in a fixed effect setting is.
That's never seen that. That's really interesting. So thank you. And could you show slide 19 also? 19.
Oh yeah, of course. 1 second. This is exchange rate shocks. Yes.
Yeah. Am I right that? So this is the impulse response function, right?
Yeah, this is a IRF from the VAR estimated from this estimated bar.
And if I'm interpreting this correctly, the shock in ER have positive impact to employment growth, right?
Yep,
the right
correct.
Bottom. And what is the interpretation for this? Because
actually, it's the top right corner.
Yeah.
So this is an appreciation shock. The variable is transformed such a way that it's a 1%, 1 standard deviation appreciation shock, and the response for employment is. So as I iterated earlier, this could be just sectoral compositional effects. So since this particular model that we're looking at focuses on Malaysia, it's mainly a services heavy, at least in the period that I covered. It's a lot more services heavy compared to manufacturing dominant economy, being a dominant manufacturing dominant economy. So transition towards that. So that's the context. And what the intuition is that like the exchange rate appreciates, with the purchasing power of households, etc., firms, at least those who are catering to the domestic economy, those whose income are not dependent on exports, who are not receiving proceeds in dollars, for instance, or foreign currency, their purchasing power increases relative to, say, the prices of imports. So there's this boom in the services sector. But what I posit is that, as I draw from is that really these services sectors, they are less productive, number one. They are more labor intensive as well, but also real wages, etc. The income that they pay out is a lot lower than in the manufacturing sector, which tends to be more productive and more capital intensive. So whereas even as the income component, the aggregate income falls because manufacturing sector suffers more, the boom in employment in the less productive services sector generates this divergent response between employment and GDP growth.
So thank you.
So to explain GDP growth, manufacturing sector dominates. To explain employment growth, the services sector dominates. That's how I would explain it.
Interesting.
I hope that helps.
So we are out of time, but I think that we have time for 1 or 2 comments or suggestions. If you have, go ahead. Well, if not, let's enjoy coffee break. Let's go to the kitchen and have some coffee. Yeah, thank you for participating in this session. That was first time for me to serve as a chair of online conference. Interesting. Hope that will not happen next year. So thank you for the participation, for the interesting presentation, and see you on next session, which will start in 5 minutes.
So thank you for the invitation and for the comments. Thank you.
Thank you.
Thanks, everyone.
Okay. So the effect of urban transport infrastructure on socio-economic outcomes, case of Nairobi's Thika highway. So trade intensity between 2 neighboring regions is inversely proportional to the distance between these 2 regions. That's according to Krugman's general equilibrium trade theory. Hence, transportation is very important in communication and commerce. So there's a wealth of scholarly research on the importance of transportation on market access. There's this literature from the US by Donaldson and Hornbeck, another paper by Donaldson again, and some literature looking at Europe, that's rating in STEM when they look at East and West Germany. In Africa, Iran's Longfeng and Fori, as well as Jedwab and Moradi, they also find some historical investments, evidence that historical investments in railways had a positive effect on economic activity. In Southern Rhodesia, Chingozha and Fonfintel show that market access is necessary for land titles to work, because when farmers are located close to main highways, to railway infrastructure, they are able to transport their produce to the market. So there indeed is clearly a case for investment into transformation infrastructure. So apart from the raw setup, transportation is also quite key in urban areas as well. That's according to Frockenberg and Platzak. Also, Tsivanidis in 2019 found that Bogota's transmillennial urban bus rapid transport system, it made distant employment opportunities much more attractive than previously. And it also influenced wage increases, among many other factors. So what is my research contribution? It's because there hasn't been much scholarly work on the effects of urban transportation infrastructure in sub-Saharan Africa. An important issue in the context of Africa is that many infrastructure projects are financed externally. So there's a whole social political debate going on there, but I'm not gonna get into those details. And there are proponents and critics of this funding model, where you get, the Chinese, different, bilateral and multilateral arrangements financing infrastructure development in Africa. Regardless, it's important to investigate the socio-economic effects of such externally funded projects. So two works that are closest to this research are the work of Siro and Sinchangi. So the Thika Highway, these are the two papers which are in my perusal of literature review. These are the sort of works that are much closer to this, to the study. So these two subjects, these two papers, one focused on differences in land use changes using a GIS approach. The other one looked at the effects of this highway qualitatively. So both studies do not attempt to tackle the problem in a causal fashion. However, my study is framed in a quasi-experimental fashion and uses different outcome variables. So I should also say that this is very much preliminary work, and I'm sure and I'm hoping that it can actually benefit from the feedback from some of the participants. So I'm looking forward to your feedback. So before we even go into the study, we already foresee some problems. The first one is omitted variable bias. So according to Falkenbroek and Platzak, they say that transportation infrastructure is an insufficient condition for growth. So when you're looking at the effects of transportation infrastructure on the growth of the economy, you obviously have got an omitted variable bias unless you can be able to deal with all those other confounders. So on the topic of confounders, so prices, availability of land, labor and capital, tax rates, environmental factors, quality of life, there are many other confounding factors that affect this study for us to really say that whatever outcomes we are observing, we are measuring, is actually a direct reflection or a direct result of the construction or modernization of this highway. But to try and mitigate some of these issues, the study uses both household level outcomes as well as small area level outcomes, just for sort of a robustness check as well. We also have measurement error because we are relying on demographic health surveys, survey data sets. So we have two waves before and after the modernization of this highway. So the problem now is in urban areas, the geolocations of DHS coordinates are dispersed by within a 2-kilometer radius. So we do have some substantial measurement error there. So just a little bit of detail on this highway. Thika Highway is a super highway that connects Nairobi, the capital city of Kenya, to a town in the north called Thika town. It was modernized between 2010 and 2012. It links Somalia, Ethiopia in the east and in the north respectively. The highway expansion entailed improving it from a 4-lane to an 8-lane carriageway under Kenya's 2030 vision. So the paper focuses on a 50-kilometer stretch between Nairobi and Thika, as I'll show in this picture here. So if you see, so the Thika highway is from Nairobi, from the center here, and you go to the north, to the northeast. So that's Nairobi, and so this is the highway, right? So what I essentially do in the identification, I look at these other major highways. So areas which are in these other 3 highways, to Naivasha, to the top left there, and this other highway, these are areas in the untreated regions because they didn't benefit from the construction of this highway, of the Thika highway. Whereas areas which are close to Thika highway, I consider them as treated regions, as I'll explain in my in my identification. In terms of the data, like I said, I used the DHS survey dataset for 2008 to 2009 because construction of the highway took place between 2010 and 2012. So the 2008-2009 wave of the DHS is the pre-dataset, and the 2014 is the post-intervention dataset of the demographic demographic health survey. As a robustness check, I also do a falsification test where I take another survey, another wave for 2003, and then sort of assume that the intervention took place between 2003 and 2008, just to see whether I can see, the same effects, and I will be showing the results later. For the ward level analysis, I just use the night lights data. So here I'm looking at small area estimation to see whether night lights can actually pick up some of the changes in improvements in welfare due to construction of this highway, but the identification is essentially the same. In future, I intend to be using roof reflectance, and I'll be using the normalized difference metal condition index. So when I'm using the difference, the normalized difference metal condition index, because roof reflectance can also be a proxy for for welfare. So when you look at the Thika highway in green here, it's going to the top right there. This is Thika highway. We've got this slum here called Mathur, right, which is near this highway, and we've got another slum here further down south, which is called Kibera. So obviously Kibera didn't necessarily benefit from the construction of this highway. So we compare outcomes here using the roof reflectance, because roof reflectance can actually tell us about the socio-economic status of a particular household, but this has not been done yet, this using the normalized difference metal condition index as an outcome variable. Moving on. So in terms of my identification, I ran 3 separate regressions. So what I do is I look at wards through which these 4 roads, wards through which these 4 roads cut through. So Thika highway is going from here, from the center here, and going in the direction of the northeast. So any wards in which this highway passes through, I consider them as treated wards, and the rest of these wards here, I consider them as untreated wards. I also do some 5-kilometer and 10-kilometer buffers, but the approach is more or less the same. These are the buffers which I'm just talking about, and these are the preliminary estimates. So cut through wards, the first 2 columns, the column 3 and 4, I'm looking at all wards which are falling within that 5-kilometer buffer on both sides of the road. And 10-kilometer buffer, I'm looking at 10 kilometers, it's a 10-kilometer radius around the roads. So what we can see is that if you look at the interaction between treat and post, we sort of see this positive effect is measured by night lights. So we are using night lights as a proxy. So this is a small area estimation. So this is the baseline regression in column 1, 3, and 5. And then in the second column, that's column 2, column 4, and column 6, I then also control for population. I didn't have a lot of controls, and as I've said, this is a really preliminary work. So we find this positive effect if you're looking at small area estimation. We also look at households from the DHS clusters. We are looking at clusters which are falling within the control regions, as I showed earlier here, using this picture. All households which are falling within these cut-through wards around the Thika highway, and also here as well as here. So is this now at the household level of the analysis? So at the household level of analysis, I also do control for more, controls progressively, but we sort of see that the effect is robust across all these columns. We continue seeing this. So for the outcome variables for the household level of analysis, I use a simple asset index, which I create, as well as a DHS wealth index as well. We sort of see improvements. So I control for many variables. We also see, if you look at the dummy for retirement, we sort of see those who have retired have got less sort of assets, which means that this construction of this highway actually benefited the labor force. You can now go and do some work at a much more distant location. So we also see some of these employment effects. Then lastly, these are the falsification tests, and we don't see any effect when you look at treat and versus the false post. In this case, we just take the intervention period slightly backwards and see if we can sort of get the same effects, but we don't get any effect. So to some extent, I think we are sort of, more or less arriving at causality, but who knows? I'm looking forward to your feedback. So in conclusion, it appears the highway construction had positive effects on welfare, also assets and employment. We are still to test the effects on roof quality and on the probability of employment. Thank you very much for paying attention.
Thank you, Tawanda. Any question directly, since Tawanda then go. I do have a question, so we have 3 minutes. The question is, I really did not understand very well the relationship you wanted to highlight between the transport infrastructure, so this highway construction, and the socio-economic outcomes. So in this very short presentation, you didn't have the time to present what is the economic relationship of your empirical test. So for instance, what is the economic relationship between the infrastructure, so the highway construction, and retirement?
Yeah, so I would say there's a whole wide literature. There are a lot of angles I think you can attack this from. For example, we can see a reduction in transaction cost, specifically travel time, which then means that once you can save on travel time, then maybe you can increase on productivity, which should also translate into more earnings. And also even in terms of probability of employment, once the friction, the traveling friction to distant locations are removed.
Yeah, but which is the relationship with the retirement? I don't understand.
Yeah.
So what is the relationship between the highway construction and retirement? What do you have in mind?
Oh, and retirement, right? So because the kind of variable I'm using here, it's a dummy variable. So I'm looking at this when you compare the subgroup of people who are still working, who haven't retired yet, and you look at those who have retired. You see that those who have retired, we are seeing less, effects compared to those who are still working, which sort of shows that the construction of the highway benefits those who are still able to go and look for a job. Yeah.
Okay, I do understand. Okay.
Thank you very much. Yeah.
Okay. Other questions? Okay, if there are, yes, please.
Yeah, I have one question. It was a good study, and I just want to know how long after building the road you did this study, because it is in research that during the construction phase, we saw some job opportunities and some economic effect on the region, but it disappeared like around after 3 years. So please can you know how long was after construction of this period you conduct this study in the area?
Yeah, thank you very much for raising that valid point. I think maybe I have to see if I have to buffer with maybe additional data sets and see if this effect is long term really. But that's a very valid question. Thank you very much. I will look into that. Yeah.
Okay. Other question? Short question. Okay, so I think we can move to the second presentation, which is by Salah. Thank you, Tawanda. So Salah and David Tripe on the climate change and stock market, range of Canadian weather. So I think Salah is going to present. So the floor is yours. So you have 12 minutes, and then we will collect a question at the very end. Please.
Okay, thank you very much. I'll try to cover within 12 minutes. It's okay, that's enough time. Okay, so as she introduced Paula, that I'm Salah, I'm a presenter, and my co-author David, I hope, will be sleeping in New Zealand. And that's amazing opportunity we got from COVID, that here it is early morning and you guys are writing in the evening, and my co-author are already sleeping. So that's fantastic. And yeah, my study is around climate change and yeah, so the motivation of my study came out that in last few decades, the frequency and intensity of extreme weather events have tremendously increased. And similarly, it's more increase in Canada. Even recently, you can see in the news, it's happening in the US too. So here, there's policy concern in Canada that because we are a bigger geographical region and we have more extreme weathers, so these events are more significantly affecting us as compared to most of the developed economies. So my motivation was to let's see, is it just a debate? Because in our last election, there was debate whether has an effect or not. So I decided, okay, let me study with the data that is it a real climate risk to our economy or not. So for that purpose, I select a stock exchange. That's one of the world's, I think, ninth largest stock exchange. So I go, let me see effect, because it's even bigger than our GDP economy. So therefore, I study the effect on the returns of the stock market and assess that is there any risk to our economy or not. Because if there's debate that might be insurance is covering everything, we don't need to worry. It might be only macroeconomic impact, but this I'm going to look at a little micro level. And this is the first study, as per my knowledge, in Canada, and to study in spite of this tremendous change in the weather, and as well as one of the important world economy. And so my objective was to provide some policy implications that it is real. And because I'm actually a banker, so when we offer investment to clients, we let them know all kinds of risk. So I was thinking that if it is a risk, we should disclose to client that which company is more vulnerable to this climate change and which one isn't. So client keep in mind, because nowadays clients are very selective. They have so many requirements that from ethical point of view, some interest point of view, some environment point of view. So I'm looking at if there is a risk, that is our responsibility to introduce that risk in the prospectus of our investors, our investment companies. And this study, mostly I saw the pioneer study that was done by one of my friend, Andrew Worthington, and one of his co-author in Australia, because Australia is another country which has faced a lot of extreme weather events. And they found that like bushfire, cyclone, earthquake do major effect on market return, but they ask that floods and the storms are not significantly affecting market returns. And then when it went to the overall stock returns, another study by Wang and Kutan, they compared Japan and US, because they are also two developed economy extremely affected by the weather. And they found that overall market return are not significantly impacted, but insurance sectors, who is facing all loss of that weather events. And another study was conducted by Lian recently, and he found that because US is famous for hurricanes, they asked that there is impact, but it's short term, but over the long term, there's no significant effect. And another finding was Lian et al. Study that the stocks with high momentum, which is consistent with our investment theory, that high momentum stocks are mostly first to be affected by any fluctuation. Yeah, so they asked that high momentum stocks are more negatively affected, and market illiquidity will be another effect of extreme weather events. And then another study, we saw that conducted in 2017, and it is consistent with 2008 Australian study, that impact of extreme weather events may differ from sector to sector, as we discussed that some sector will be more impacted as compared to other, and similarly geographically, the affected area, and especially office of the company, if headquarters is in affected area, they will have more effect as compared to other companies. And in Canada, there's no empirical study, I find, but there are a few policy study governments conducting, because they have formulated a very good action plan for to control the climate change. And therefore, they conducted some policy study, and they asked, there is climate change risk in our economy, and that need to be investigated specifically, which sector are more or less impacted by the weather events. So my methodology, I took data of extreme weather events from 1988 to 2016. I selected 1988 because it was the first time UN recognized the risk of climate change, and IPCC was formed to fight against climate change. And the data is available up to 2016 because they published the data with all figures. And after 2016, some fragmented data is available, but properly consolidated data wasn't available with Canada disaster management. So I take up to 2016, and stock exchange data, it was available. That wasn't any issue, but because of my disaster data was up to 2016, so I took the stock exchange data also to 2016, and I took a Toronto Stock Exchange composite index, which represents 95% of market capitalization. And then I collected some subsector data to see which sector is affecting more as compared to others. And the methodology, I keep the simple because my objective was to show to the common investors that when they are investing, so they should keep in mind that this company is vulnerable to climate change. So I simply took the daily average return and then it took its average. So we all know that return is that change in index from last year to today. And then I calculated daily average return for the specific period, impact period, and I took 5 days. That's mostly common because broad studies has identified that it's mostly short-term effect. And second, when we took too long, sometimes it is overlap with other events or weather events and as well as some economic events. So I took 5 days after the event. And then to find association, it wasn't possible to build association between daily returns because number of observation was totally different. Number of observation was different in event period because that was only 5 days for each event, and as compared to index, that's like large number of days. So therefore, what I took to make a balance data, I took a quarterly average for the daily return of the index market and as well as quarterly return of our impact period. And my study showed that it is actually non-parametric, data is non-normal, so therefore I took a non-parametric test. And here's some numbers. You can see that our index has grown by 382% during the period, and highest growth was in consumer staples, and followed by financials, and on the third number was, energy sector. These are just descriptive statistics that how these index perform over the study period. And here we calculated daily average returns. So for the whole composite index, if you see, daily return was 0.02%, and on the day of the event, there wasn't any impact, but on the 1 day after the event, we can see the minus return. And from the risk point of view, we can see fluctuation, standard deviation is highest on that day, and which is higher than the market and higher than the rest of the days. So that we can see that the impact is there. And the next step was to see, is it statistically significant? For that purpose, I used this table, and we found it significant at 90%. That here, that quarterly average is a little bit different from daily, but still result hasn't changed. That it is negative and it's negatively associated with the market. And similarly, if come here, standard deviation still is the higher, far higher than the market, but it is highest among the study period. And after that, we saw that it is negative and this is significant and is mostly on the next day of the event, because the logic behind it look like that event once come in the news, we are not sure what kind of impact is there until next day. Mostly it is reported well that what is actual impact there. So look like it come the next day. So then we came on the sector-wise that where is the highest impact. And although financial sector is the highest among the rest, then IT, we didn't find any relationship with the kind of weather, but it is with the earlier study identified that high momentum stocks are the first to be affected by any shock. So IT sector is the highest high momentum stocks. So definitely they are being affected on the next day, highest among others, but they are not, we are not expecting it is due to weather. It is just because risk was coming, they were first to react. But real risk came to the financial sector because their insurance and banking, they mostly suffer the loss of real property or the other infrastructure impacts, because mostly they have an interest in those properties and they need to pay off the people. And after that is energy sector, that is a debate all over the world that due to climate change, energy sector will be the first to be severely impacted. So we saw that they are on the second number in the impact, and then it comes to the healthcare and basic materials, utilities. And another interesting thing we found that consumer staples are not being affected by the weather events because people eat either good or bad shape. Yeah, so therefore it's not there. So these results also looks consistent with the argument that yes, climate change has a risk to the investment and economy. Yeah, so my conclusion is that a significant and negative impact of weather events is observed on the next day of the event, and it's short term, but it is shock to the economy. People, it look like investors' perception is worried about weather impact. And in the sector-wise, financial, IT, and are the most affected, and consumer staple is the least affected by the weather events. And the interesting thing is that it's more widespread in Canada as compared to the rest of the. Most of the countries found only on the insurance sector, but in Canada we saw that 9 out of 10 sectors are affected by the weather events. So the concern is valid from the policymakers that the warming in Canada is double than the global warming. So therefore, impact should also be widespread. And that's it. Let me know if you have any question or suggestion.
Thank you, Salah. You are perfect in time, so thank you very much. And maybe I have a very quick question, and which is are your results online with the result obtained on other countries, or somehow they are different from existing results?
Yeah, my results are, you can say, more stronger than other countries. Mm-hmm. Like I compared with Australia, in US and Japan, impact in Canada was higher. It was there because those countries has impact, but it was not in other than insurance sector. And but here we found that yes, financial sector is highest, but other sectors are being affected too.
And do you have an explanation why there is this range of different? So because it could be also interesting for policy purposes to understand what drives these numbers. So why for some countries are more relevant, for others less, and so what are policy implications?
Yeah, my argument around is that as policymakers are asking that in climate change in Canada is higher than as compared to other countries. So mm-hmm. Therefore, I think because Canada has both extreme weathers, hot and cold. So I think in both sides that weather events are coming. Therefore, impact is higher.
Okay, thank you very much. Other questions? Curiosity, short question. Okay, so I think we can move to the next speaker, which is Phuong Nguyen. Sorry for my pronunciation if it is wrong. And the paper is about a household resilience to natural disasters, so somehow a related topic, the role of housing characteristics. Please, Phuong, the floor is yours.
Yeah. Thank you very much. Can you see the screening
yes.
I'm sharing with you?
Thank you.
Yeah, thank you very much.
Thank you.
Yeah, thank you, Paula. Good evening, everyone. My name is Phuong from Amity University, Australia. And now I will present the topic titled Household Resilient to Natural Disasters, the Role of Housing Characteristics. So, as you know, many studies have shown that the natural disasters bring about various socio-economic damage, including casualties, severe severe property damage, income loss, and worsening household per capita expenditure and poverty status, and even widening income inequality. So consequently, over the long run, most of the households that fall into the poverty trap caused by the negative impacts of natural disaster by themselves unable to recover to their initial welfare situations. However, studies have also found that the impacts of natural disasters vary among countries, regions, households, and individuals because they are influenced by the level of resilience of households to those disasters. Therefore, in this study, we aim to answer the following questions. What housing factors affect households' capacity to recover from natural disasters in Vietnam? Our study focused on 3 most frequently occurred disasters in Vietnam separately, including floods, droughts, and typhoons. So why Vietnam? In fact, Vietnam provides an interesting case to study natural disaster resilience because of 2 reasons. First, Vietnam is ranked as one of the 12 countries most vulnerable to climate change and one of the most disaster-prone countries in the world due to its proximity to long shorelines and sizable populations and economic activity in shoreline areas. And second, the country has a high proportion of the population residing in deprived housing conditions. Therefore, housing has been identified as one of the sectors most vulnerable to climate change in Vietnam. However, to our best knowledge, so far, no studies have investigated the relationship between housing conditions and household resilience to natural disaster in Vietnam. So with this study, we attempt to contribute to the literature in a few ways. First, we, in terms of the operationalization of resilient concept that is related to household welfare outcomes, our study contributes to the literature by looking at a more comprehensive way of measuring resilience, which is the capacity of households to recover post-disasters. So current literature mostly focus on indicators such as income, expenditure, poverty status, food insecurity, skipping meals, and so on, as the indicators of household welfare outcomes that reflect resilience. So we contribute to the literature in this regard. Secondly, in terms of the measures of determinants of resilience, we focus on a wider range of housing factors. So the current studies often focus on similar factors that predominantly related to socio-economic factors such as income, education, and age. So we focus on housing factors in this study. And finally, we attempt to add to the growing literature in the context of the developing countries and at household level analysis, which is still scant in the literature. So we, to answer our research questions, we employ the Vietnam Access to Resources Household Survey Data, or the VIII, in the 3 ways from 2012 to 2016. This survey mostly covers rural household living in the 12 provinces of Vietnam, as highlighted in the figure here. So to measure household resilience to natural disaster, we use a Likert scale measure of recovery status of the exposed household from each type of disaster shock. And this dependent variable recovery status is an order variable with the value of 1 if a household reports to be still suffering badly, value of 2 if a household reports a partial recovery, and value of 3 if a household reports a full recovery. So our main independent variables of interest in this research is housing characteristics, and they are constructed using 5 items. And these including the construction materials of surrounding walls, which has 3 categories. The construction materials of a roof, which includes 5 categories. The source of water for cooking and drinking, which is an indicator of access to water service. And this has 8 categories. We also have a binary variables indicating the tenure status of the households, and also the living area per capita, which is an indicator of overcrowding. We also control for a range of potential socio-economic, demographic, and locational factors that are often found to have a impact on resilience of household to disasters from the literature. We also control for household characteristics and the locational factor, which indicates a location of a house. So given the nature of the order response data of the dependent variable, we adopt a pooled order probit model for econometric analysis. The order probit regression technique is built around a latent variable model where, as you can see here, YIT star is the unobserved dependent variable. And in this case, it is the recovery status of the exposed household from each type of disaster. However, because YIT star is unobservable, so we instead observe the following. So we instead observe YIT, and this equal to 1 if household still suffering badly, equal to if household reports a partial recovery, and it's equal to 3 if household report a full recovery. And if YIT satisfies these conditions of mu I, which is the unknown threshold parameter to be estimated with our vector of coefficient beta. In this table, we show the pooled order probit model, which include the estimated coefficients and the marginal effects of the 3 disaster types. In particular, the first 4 columns report the regression results for flood. The next 4 columns show the results for drought, and the last columns are for the typhoon. So in terms of the construction materials of the surrounding walls, the result consistently, you can see the result consistently show that household residing in a dwelling with outside walls made of leaves, branches, bamboos, and earth, which are poor quality materials, they are less resilient to all disaster considered, relative to those living in a dwelling with outside walls made of brick or concrete, which is good quality materials, because you can see that households are less likely to recover completely and more likely to report a partial recovery and still suffering badly from these shocks. For example, let's say in the event of flood, as you can see, the result from the marginal effects in column 3 and column 4, they indicate that households living in dwellings with outside walls made of these leaves and branches and bamboos and earth, they tend to have a 23.5% lower probability of full recovery and 8.6% higher probability of recovering only partially from floods. On the other hand, as you can see here, the construction materials of a roof appear to have a significant impact on household resilience to the event of typhoon, but not flood and drought. In particular, you can see that relative to household living in dwellings with roofs made of concrete, those with roof made of straw or leaves or tar paper, which are poor quality, tend to have a higher probability of still suffering badly and a lower probability of full recovery when they are exposed to typhoons. So this result is meaningful because a roof tends to be the first being blown away under storm force winds. And similar findings have also been observed in a study in Nigeria in 2016. In terms of the source of water for cooking and drinking, we find that compared to households having a private tap water reaching their house, those who rely on bottled water, either in a tank or in bottles, for cooking and drinking, tends to be less resilient to both flood and typhoon. Instead, for households exposed to drought, those who have a water tank in their house tend to be more resilient, and these results are highly significant and 1% leveled. And this effect has also been observed in many Australian cities where households view tank water is a personal supply to safeguard household lifestyle against water restrictions or a reduction of their dependence on main water supply in response to drought. in Australia and also in China as well. And finally, we can see here that home ownership and housing area per capita are only significant in determining household resilience to typhoons, but not floods or droughts. And in line with our findings, a number of studies have also demonstrated that in the absence of formal land or formal home ownership, the tenants have neither the incentive of investing in their property nor the willingness to apply disaster resilient housing construction techniques compared to owner occupiers. So in general, our study finds that some housing characteristics are resilient to different types of disaster, while others are not. And these results are summarized here. However, because of the constraint in time, so I wouldn't repeat all these conclusions. So I will jump to the policy implications. Also, here, we are all aware that because understanding the connection between disaster and poverty is essential to poverty alleviation and economic development. So the findings in our study provide some policy implications as below. First, our study suggests that in designing coping strategy for people who live in areas exposed to different types of disaster shocks, the government and non-government organizations, as well as sponsors, they should consider different housing programs and policies, as well as adaptive strategies for these people. Besides, in order to address climate change, which directly affects the severity and occurrence of natural disasters, housing should be viewed as a key area because better housing conditions can have a direct relationship with the recovery process of household exposed. And finally, one main reason for the existence of deprived housing conditions is due to poverty and unaffordability. Therefore, in most cases, the disadvantaged and the poor households, particularly those living in disaster-prone areas, with limited access to adequate resources and facilities, are the major victims of damage caused by disasters. Therefore, these people should be put in top priorities to receive assistance program. So we also
have less than 1 minute because you are out of time.
No,
yes, please.
Thank you very much. Thank you very much, Paula. So we are also very keen to look for ideas and suggestions so that we can improve our research. And we particularly look for any idea that can point out is there any weaknesses or a gap in my research or any key recent literature in this topic that we haven't covered, or any suggestion in the modeling method and robustness checks. Thank you very much for your attention.
Thank you, Phuong. Thank you very much. So any question, curiosity or quick question? I just have a quick question. It seems to me that your study is very interesting, but at the same time, I would suggest at least an interpretation of your result. It seems to me, working on energy poverty, it seems to me that all these housing characteristics are really relevant for your topic, which is resilience. Okay, so maybe one way to sell your result, if you're looking for some further suggestion in this direction, could be, okay, look, obviously a key point is vulnerables, poor people, or any kind of troubles from climate change and so on and so forth. But how could we address priority among all this group of vulnerables or among these poor? And one way could be to have a look to the place where they live, or the infrastructure, or the house they have, they live. And with your empirical analysis, you can somehow design some form of priority in this direction. So, having a group of vulnerables, given your empirical analysis, you could give a priority to which group to address first. Why, since you are observing this kind of characteristic of the houses, access to resources or whatever. What do you think?
Thank you very much. Yeah, I think that's a great idea, and we will take into account that and we further explore that in the future. Thank you very much.
Okay, good. Any other point or question or curiosity? If not, we move to the last presentation, which is by Dmitry Kashin. It's a joint paper with Dmitri Vinogradov and Elena Shadrina, and it is about environmental criteria in public procurement, determinants of contracting authority decision. Dmitry, the floor is yours, 12 minutes.
Good afternoon, dear colleagues. I would like to present our research on the conference with Elena Shadrina and Dmitry Vinogradov, Environmental Criteria in Public Procurement of the Russian Federation, Determinants of Contracting Authorities' Decisions. So the structure of my presentation is the following. Firstly, I will mention research question and motivation of research, then talk about institutional framework and theoretical background, about data and methodology next, and results and future research. Firstly, let me mention the motivation of our research. It's a well-known concept that state priorities may be in different spheres. In economics, there may be social state priorities, in the sphere of defense, in the sphere of education, etc., and of course in the sphere of environmental safety. Different countries implement these state priorities according to their own specifics. For example, there are different prioritization in every country, but different budget costs, explicit or implicit mechanisms, and more factors. We focus our research on environmental safety priority. And I want to mention that priority of environmental safety may be implemented through different mechanisms. For example, through shaping individual behavior, through working with business, and through public procurement mechanisms. We focus our research on public procurement mechanisms, and for example, in European countries, this mechanism really works. The objectives, for example, of environmental safety are set in the European Union directives on public procurement and in the national legislation on public procurement in different countries. But what is the situation in Russia? In our country, priority of environmental safety is stated in the environmental safety strategy. And for example, it's implemented through the federal law number 7, which is named on the environmental protection. But the priority of environmental safety in Russia is not included in the laws regulating public procurement. These are two laws, 44 federal law, which regulates all budgetary institutions, and 223 federal law, which regulates almost companies funded by the government partly. That is, public procurers, for public procurers, this priority is implicit, so there are no concrete instructions how to implement environmental criteria in their procurement activities. Thus, the research question appears. So, do public procurers in Russia apply environmental safety priority in their procurement procedures if there are no laws and instructions for these? Then we think that what types of public organizations are more willing to use these environmental criteria, and what factors influence the implementation of environmental priority into public procurement activity of public bodies in Russia. So these are the research questions we posed, and let me speak about theoretical background. I will speak about it in not a traditional way, but through our hypothesis that we stated in our research. So hypothesis number 1 that we made, that organizations operating under 44 federal law and 223 federal law will apply environmental criteria differently. We suppose that the closeness to the power will play a big role there, and organizations operating under 223 federal law will implement these environmental criteria more frequently because they are only partly funded by the government, not totally like budgetary institutions or different state organizations. There are a lot of literature about this hypothesis. Next hypothesis, number 2, that big organization, we measure size of organization with the help of annual procurement volume, will be more inclined to implement this environmental criteria in their procurement activities. And there is also literature proving this hypothesis in Europe, but no literature about this in Russia. Hypothesis number 3, that federal and regional authorities, so the level of power, will also affect the decision of implementing these environmental criteria in procurement. And hypothesis number 4 to number 8, we think that some internal and institutional factors will influence the decisions of contracting authorities. For example, the presence of procurement department in the organization, knowledge about environmental criteria as well, the presence of strategy in public body, willingness to use model criteria, which may be stated as we suppose by the government or by NGOs, and the usage of information from official standards. All these criteria will influence the decision of public bodies to implement environmental criteria or not. About data and methodology of our research. We made a big review, a big questionnaire in years 2017 and 2018, and in the questionnaire took part 275 public organizations from 22 regions of Russian Federation. This study was based on global review of sustainable public procurement and on the research of by Bauer, but in this research Russia was not used as a control group, and we based our survey on this research in order to compare it with international practice in this sphere. We cleaned the database from the outliers, and we got 223 public bodies that we evaluated through econometric methods. We used probit regressions and all descriptive statistics that I'll show you now. But firstly, the model that we evaluated in our research. The dependent variable in regression model was y-echo and y-echo quantity. And this is a binary variable that took only 2 values. 1, if public body used environmental criteria, and 0 otherwise. And the second regression, which was made for like a control regression, also has 2 values, 1 and 0, a binary regression if public body used environmental criteria often and or rarely. We want to measure the frequency of usage of environmental criteria by implementing and by evaluating this regression. Then we divided all factors into institutional factors and internal ones, and institutional factors were the presence of public procurement department, public procurement volume, strategy, the presence of strategy, knowledge, information, and knowledge these are controls for the source of information, and presence of knowledge but in public body in using environmental criteria or not, and the willingness to get this model criteria from the government or from NGO. And institutional criteria, law by which the organization operates, level of power, and type of public body. So let me show the results of probit regressions that we've got. And this is the joint database, 44 federal law organizations and 223 federal law organizations put together. So all our database. And there I'll put attention on the coefficient near variable law in the usage of environmental criteria regression number 2. And we may see that there is a difference in implementing environmental criteria by organizations operating according to different laws. So one was law number 44 and 0 value was law number 223. So we may see that contracting authorities operating under the law 223 are more frequently in implementing environmental criteria in their activities, in their procurement activities. And these results give us opportunity to split the sample and to analyze separately 44 federal law contracting authorities and 223 federal law public bodies. So results that we've got from 44 federal law analysis, we may see what factors influence the decision of public bodies to buy green or not. For example, the level of power influences the source of information. We may see significance there, and the willingness to use model criteria stated by the government or by NGOs. So these factors are for totally funded by the government state organizations. And what about 223 federal law organizations? There are other criteria, for example, type of public body, public procurement volume. So this is the measure of the size of organization, and it is also significant in our binary regression probit models, the presence of strategy, source of information as well, and the willingness of stated model criteria. Let me show the results of research by proving the hypothesis. So hypothesis number one, that organizations operating under 44 and 223 federal law will apply environmental criteria differently, was proved, as well as hypothesis number two and number three were also proved, but we understood that there is a law specific. So these hypotheses were proved not totally, but according to the law specific. Hypothesis number four was not proved when we got results. So the presence of procurement department doesn't influence the implementation of environmental criteria, as well as hypothesis number five was not proved. So the knowledge about environmental criteria doesn't influence the implementation of green procurement procedures. And hypothesis number 6, 7, and 8 were also proved during our research, and we obtained that the presence of strategy, the willingness to use model criteria, and the usage of information will really influence the frequency of implementing environmental criteria in procurement activities. So these are the results of research. And I want to speak a little bit about future, what we would like to do in future research. So we want to use a machine search on the open data set to collect more data, to use the time effect in these data. And we want to search maybe for other factors that will determine the decision of public bodies. And
1 minute, 1 minute.
Yes. Thanks. And make recommendations for policymakers about mechanisms of how to include these environmental criteria in Russian laws about public procurement. So in 44 federal law and 223 federal law. And in conclusion, I want to say that our research shows that Russian public bodies systematically use environmental criteria, but policymakers need to think about how to improve the frequency of usage of environmental criteria in Russia. Thank you very much, and I'm open to any questions.
Okay, thank you very much. Any question, curiosity from the floor? I just move with my question. So as in one presentation before, the point is that with this very short presentation is very difficult to understand sometimes variables. So for me, it was not really clear when you use the variable strategy. What do you mean by strategy? So when you have the result, there is one variable is a strategy. What do you mean by strategy?
Thanks a lot for the question. By strategy, in our research, we mean the presence of strategy. So two values, a binary variable, one if there was a strategy in this organization, and 0 if there were no stated strategy.
Yes, but how do you control this? So what is the data for? So how which kind of information do you have to see if there is a strategy or not?
There was a big study made by Elena Shadrina in 2017 and 2018, and it was a study of contracting authorities. So a questionnaire, and we obtained these internal data. Yeah, we can't get this data from open source, but it was a questionnaire of public bodies.
Okay, good. And another question, do you find any effect related to size? So are they using this environmental criteria if they are a big public buyer or a smaller one? So is there any difference given the public buyer size?
Yes, thanks a lot for the question. We got this significant result only for public bodies under 223 federal law, so not which are totally funded by the government, but which may have a commercial things as well. And for these organizations working under 223 federal law, the effect of size was significant. So the effect was significant on 10% level. So if the organization was big and had big volume, procurement volume more than 10 million, we also divided by like two values. One, if the size was more than 10 million annual procurement volume, and 0 if it was less. And we got a result that big organizations implement these environmental criteria more frequently than small ones.
Okay, good. Thank you very much. Other question, I see Svetlana. Ciao, Svetlana. Do you have any question?
Ciao, Paolo. Yeah, probably yes.
Good. Go.
Yeah.
Go.
Could you tell me, please, did you control your research according to geographical distribution of your observations, or maybe you suppose some dependence on geographical distribution of territory distribution of the company which been under investigation, under your research, under your investigation?
Thanks a lot for the question, but really in this research we don't control for the region and for the territory, but really I now suppose that maybe there will be a regional effect. For example, in Moscow or in St. Petersburg, they will implement these criteria more frequently than in other regions. But we need to test it. Yeah, thank you.
Mm-hmm. Thank you.
Okay, other questions? Okay, I think we can stop here. And if you have a question about the presentation, or if you wanted to ask for materials, I think it is the case to write an email to the presenter and ask, and so to have some sort of private interaction. I saw that Phuong is asking me to have some discussion about, and please send me an email and we will agree about a Zoom meeting, and then we can discuss about your paper. And it is the same for all the others. So thank you very much again for being here, and then let's hope that the next iCare will be in person, so we can enjoy much more. Okay. Bye. Thank you. Bye. Bye. Ciao, ciao. Have a good evening.